There are two approaches commonly used to cost products for valuing inventories and for determining cost of goods sold. Absorption costing is required for external financial reporting because it treats all costs of production as product costs, regardless of whether they are variable or fixed. Variable costing, useful for internal decision-making purposes, treats only variable production costs as product costs. All fixed costs are treated as period costs. Variable costing dovetails with contribution margin income statements and draws upon cost behavior.
In variable costing, you only assign to products the variable costs of manufacturing them. Again, this is a manufacturing concept. So you do not assign to products the fixed cost of manufacturing them. Why would you do this? Well, you would do this because for purposes of making decisions about, say, pricing or how much you're going to make of something, whether you're going to make it yourself or have somebody else make it, these variable costs tend to be very important. Now, there may also be fixed costs that are important, but you would separately consider those and separately identify those fixed costs that are relevant for the decision.
Let's look at basic cost and production data for a fictitious product X from company XYZ, where 20,000 units are produced each year. Variable production costs are $5 for direct materials, $3 for direct labor, and $2 for variable manufacturing overhead. Variable selling and administrative costs are $2 per unit. Fixed manufacturing overhead is $60,000 per year, and fixed selling and administrative costs are $30,000 per year. For absorption costing, unit production cost includes direct materials, $5, direct labor, $3, variable manufacturing, $2, and fixed manufacturing costs of $3 per unit, for a total unit production cost of $13. Fixed cost per unit is the $60,000 total fixed manufacturing overhead divided by 20,000 units produced. For variable costing, the unit production cost is $10 because it excludes fixed manufacturing overhead. Fixed selling and administration expenses are excluded from per unit cost in both absorption costing and variable costing. The difference of $3 per unit, the fixed manufacturing unit cost, is key to understanding how net income differs under absorption and variable costing when sales and production volumes differ. Variable and absorption costing methods produce different periodic net incomes when sales and production volumes differ. To see how this works, we'll use the cost and production data seen previously. To this, we add a unit selling price of $25 and sales and production volumes for each of 3 years. Notice that the units produced remain stable at 20,000 per year, while the sales volume varies from production volume in years 2 and 3. In year 1, production volume and sales are the same. Therefore, net income under absorption and variable costing methods is the same. This may be seen in condensed income statements. Revenues of $500,000 are equal under absorption and variable costing. Absorption cost of sales at $13 per unit production cost is $260,000. Variable cost of sales includes $10 per unit variable production cost, plus $2 per unit variable selling and administrative costs. Total variable cost of sales is $240,000. Gross margin under absorption costing is $240,000, and contribution margin under variable costing is $260,000. All selling and administrative expenses reduce gross margin to arrive at absorption net income of $170,000. Fixed manufacturing overhead and selling and administrative costs reduce contribution margin to arrive at variable net income of $170,000. Net income is the same since sales and production volumes were the same. And in this example, there is no ending inventory on the balance sheet. In year 2, sales of 15,000 units are 5,000 units less than production. This will result in absorption net income exceeding variable net income by $15,000. This is how it works. Sales revenues are equal at $375,000. At $13 per unit, absorption cost of sales is $195,000. Variable cost of sales includes $10 per unit variable manufacturing cost and $2 per unit variable selling and administrative expenses. Absorption gross margin at $180,000 is $15,000 less than variable contribution margin. So far, it looks as though absorption costing will result in a smaller net income. However, for absorption costing, selling and administrative expenses totaled $60,000, which includes $30,000 fixed selling and administrative expenses, plus $2 per unit sold variable selling and administrative expenses. For variable costing, all the fixed manufacturing costs and the fixed selling and administrative expenses are deducted, a total of $90,000. The result is absorption costing net income at $120,000, $15,000 greater than variable net income at $105,000. When production exceeds sales, as in year 2, absorption costing net income exceeds variable costing net income. Sales of 25,000 units exceed production by 5,000 units in year 3, consuming all the units produced in year 3, and the 5,000 units left over from year 2. In this case, absorption costing net income will be less than that of variable costing by $15,000. This is how it works. Sales revenues are equal at $625,000. Absorption gross margin is $25,000 less than variable contribution margin because cost of sales including fixed manufacturing overhead are $13 per unit, whereas variable cost of sales, both manufacturing and selling expense, is $12 per unit. This is a $1 difference. Multiplied by 25,000 units sold, the $25,000 margin difference is confirmed. For absorption costing, selling and administrative expenses are $80,000, which includes $30,000 fixed selling and administrative expenses, plus $2 per unit sold variable selling and administrative expenses. For variable costing, all the fixed manufacturing costs, $60,000, and the fixed selling and administrative expenses, $30,000, are deducted. The result is absorption costing net income of $220,000. That is $15,000 less than variable net income of $235,000. Over an extended period of time, net income reported under absorption and variable costing tend to even out because a company typically can't sustain sales exceeding production or production exceeding sales for more than a short period of time. In our example, periodic production remained steady. When we talk about differences in the way net income is reported under variable and absorption costing, it's important to understand how differences between sales and production levels affect a company's net income using both methods. The examples just shown compared net income reported for absorption and variable costing using a constant level of production across 3 years. Net income is the same for absorption and variable costing when sales and production are the same for the reporting period. We saw that absorption net income exceeds variable net income when production exceeds sales. And conversely, absorption net income is less than variable net income when production is less than sales.